money wise. Let's go.
Woke up feeling like a boss today. They said, boy, you know we got you, gone and do your thing.
Hey everybody, Mike Hoffman, CEO of Longhorn Investments. Our next podcast, The Longhorn Way. We are very excited to have a special guest with us, our second out of Longhorn guest. We're very excited to have Robert Durden, Managing Director.
Yes, sir.
Managing Director at Atlas SP. Robert, thanks for coming. Appreciate it.
Thanks for having me.
All right, so talk to us a little bit. And I'm going to jump a little because I know a little bit already.
Okay.
Where are you from and where'd you go to school? Most importantly.
Yeah, grew up in the Dallas-Fort Worth Metroplex from Arlington, Texas, and attended the University of Texas at Austin.
There we go. All right, so love it. When did you graduate?
2001.
Did you go to grad school?
I did not.
Where'd you go?
Went straight to work. Went to work for Bear Stearns. It was a mortgage industry name at the time.
Yes.
Started out with a brief stint in Dallas. They had an office in Irving. And then quickly made my way into an analyst group in New York City.
All right, so
left Texas.
And I'm going to interrupt you there because I'm curious about this.
Sure.
Was the goal when you graduated the University of Texas, did you say, I want to go to New York and get into the banking business?
That was probably the biggest driver, yes. And it was immediately after 9/11, it was challenged.
Yep.
The employment market wasn't great, particularly in finance. Markets had just opened back up. Hadn't had a whole lot lined up. It was a little bit challenging to make the leap. A lot of options were open locally in Texas at the time. But yeah, the goal was, to get to New York and just understand a little bit more about what I didn't know about the finance world. And
well, you were young. You didn't
That's
know
right.
anything yet.
Exactly.
I mean, you didn't know anything.
That's
All
right.
right, so let me backtrack. What degree did you graduate with from the University of Texas?
Bachelor of Business Administration, so finance.
In what?
And finance and a minor in accounting.
In accounting.
Yes.
When you were there, was it called McCombs Business?
It was.
Or
yeah.
McCombs
It was
School of Business?
Kosmetsky, and then it had transferred over to McCombs, I think, right at the tail end.
Okay.
It's actually a great question, but I think it had transferred over.
I don't know. And so, and I'm jumping ahead, but I'm going to come back. Do you recommend for young people, if they want to get into the mortgage industry or banking and they want to go to New York and you're at the University of Texas, is a finance degree, an accounting degree, an economics, what does it matter or does it not matter?
I think to some extent it matters. A lot of my friends, folks that actually moved to New York around the same time I did, all had the master's in accounting program certification or degree. I would say that was a shoe-in way to get a job you wanted with any of the major accounting firms. I think in finance it was a little more localized. There were a lot of real estate opportunities, but predominantly in Texas. Right? I'm sure the school's done a great job since then of sort of broadening the horizon. You've also got a lot more out-of-state participation, just a lot more notoriety of the school in general. So I would think the path looks a little different today than it did when I was there, like it likely did when you were there,
Yeah.
right?
I can't remember. It was so long ago when I was there, I can't quite remember.
Right.
All right, so you get your degree, you get your first job in Dallas. It's post 2001 though, not the greatest time to be looking for work. You get the job, you get to go to New York. What are you doing? You're an analyst or you're?
Yeah. So at the time, the analyst group at Bear Stearns really worked in a rotational effort, right? So you worked with trading desks, you worked in contract finance, you worked in sort of what we would consider inventory management, right? Which is a lot of analytic work around what are the value of these mortgages day to day, right? What's the optimal way to package them? Ultimately at the time, Bear Stearns was one of the larger securitizers of all things mortgage loans. So you really just were in the thick of things, right? Buying, hundreds of millions of product a month, if not billions at the peak across different trading desks, and really organizing mortgages, kind of like widgets and putting them into units that enabled the firm to maximize profitability, right?
So I'm fascinated by this. I already feel where we're going here.
Right.
I can't wait to get a few more years ahead here. So What did you do though? Because look, the way you're talking about, I understand your Bear Stearns is a giant conglomerate of billions of dollars worth of mortgages at the time. But what is Robert Durden, a year out of college, 2 years out of college? What specifically are you doing with these mortgages?
So there's a lot of, it's kind of one of the things you end up talking about in the industry that very few people appreciate, right? But there's a lot of competitive friction on a daily basis, whether it's in agency mortgages or non-agency mortgages, to ultimately arrive at a price.
So you got to back up. Remember, a lot of our crew probably is not, people listening, my mom and my mother-in-law might not know what an agency is.
Mortgage.
So tell us what an agency mortgage is.
Mortgages that are originated to U.S. real estate borrowers that meet a certain set of requirements that are effectively deliverable to the GSEs, Fannie or Freddie, right, or government insurable via the FHA, VA, or USDA, and can be packaged up into Ginnie Mae securities, right? So that's really the government world. At the time when I entered the business, I would say those collectively probably made up 55 to 60% or so of the mortgage universe, with the other 40% collectively being called non-agency mortgages. So what you do on a daily basis is you're really trying to understand, for any given mortgage loan that I've priced and purchased into position, as capital markets move around, as the credit profile of the collective package of mortgages, right, the bundle or aggregate portfolio deviates over time, the package becomes worth more or less in certain ultimate outcomes, right? So what effectively you did as a junior analyst was you just, dating myself further, but Excel was relatively new, right? You had certain models, but models versus today's standards were somewhat limited. And so you had a lot of people involved in just the regeneration of economic outcomes, and just hour over hour effectively saying, what have capital markets done? How have they moved? And how has that altered the value of this portfolio of mortgages? And how does that change the behavior of what I ultimately want to do with a given pool of mortgages, right? So that was collectively the inventory management. Obviously, there are trading desks who, still to this day perform that function. You really started out in this world as a junior resource for the trading desks, which anything you do over and over and over again, you start to absorb over time, and you understand the various outlets and what the capital markets activity that alters the value of those mortgages looks like. You take in that information, you ultimately then change decision behavior on how to ultimately exit, via either securitization, loan sale, or other forms of monetizing a pool of mortgages.
So you're essentially predicting, you're taking the pool of mortgages and you were trying to predict if things fluctuated in the market, then you're going to go tell the guys, I think we should do this with this pool of mortgages.
Well, I think that role is really owned by a trader on a trading desk. It's their position. It's their, profit or loss, right? So it's their position. As a junior analyst, you're really just starting out doing a lot of the day-to-day work and iterations through their portfolio to give them,
you're giving them
the market signals. But
I'm not saying you made the decision, but
your
your job is to show the guy, hey, I think this is what's happening. Right. He's either going to believe you, not believe you.
There's a myriad of different paths you can go down in terms of, you bought something at, just to pick an arbitrary number, 104, you can execute at 107. All day, every day you're looking at, has that fallen to 106? Is that now 108? And how do you get to different outcomes?
So let's tell real quick, I think this would be great for everybody. Let's tell our less sophisticated folks, because we have not all worked in New York and understand on trading desk, things like that. Right. When you're saying buying at 104, make it simple for us to understand, what does that mean you're buying at 104?
Yeah, for typically a mortgage loan, right? This industry, set that aside, it's a little different, but typically,
we'll get to us in a little bit.
Typically, mortgage loans will trade at a premium value upon origination, right? So, premium value to what is really your question, but the principal balance that the borrower, has borrowed and is obligated to pay back, you've got some amount of originator production cost built into what does it cost to manufacture a mortgage, right? The costs and expenses of running a business of origination, in addition to what the borrower themselves will pay.
Okay.
Right? But typically, particularly with, fixed 30-year mortgages, there's often a way to take a coupon on a loan, right? Call it today's standards somewhere around 7% for a conventional 30-year.
Okay.
And there's a way through the capital markets where you can make a 7% coupon that was originated at a $250,000 average or balance. You can make it worth through those outlets effectively 103 cents on the dollar, 104 cents on the dollar, right? There is an arbitrage that is achieved by effectively bringing together the buyers of that cash flow, right? Securitization is the effort of carving up the cash flow of many mortgages typically into different distinct timeframes as well as credit profiles, right? As to which dollar is the first dollar you attribute a loss to if you don't recover all of the principal balance. So through really the arbitrage, if you will, of looking at all of those various market signals from all the various market actors, you can put something together that is often worth more than what the value of the mortgage is, right? And then, what happens over time is if a 7% coupon is worth 104, 105, the mechanism whereby the price is altered is such that the economic actors in the market will now say, I'm willing to pay the same thing I paid for a 7% mortgage yesterday for a 6.75% mortgage today, right? And it's that really feedback loop. It changes by the hour. I mean, not so much like the type of mortgages and whatnot, but certainly the price signals. You're looking at the treasury markets. You're looking at, supply demand of certain types of securities that are created from the securitization process. You're looking at loan buyers, right? Historically, there have been all sorts of actors that come to the mortgage market to really invest their dollars of investment. And
I was going to ask, who's the typical buyer of mortgage? You were at Bear Stearns. Was there another group at Bear Stearns that was buying mortgages?
Sure, you're really an analyst for that group, right? So, in the early days of my career, anyway, the principal business, I would say, was different at that time, but there were quite a few broker dealers connected to banks, some of which who were in the business of buying mortgages for the purpose of realizing the profit that could be generated via securitization and or on selling parts of the mortgage portfolio.
Gotcha. And securitization, I'm trying to keep it simple for everybody here. Securitization is when you take a pool of mortgages, right? You put them all together, and then you take them out to the market.
Yeah.
And the market you sell them to the market and see what price people will pay for them?
You effectively, you basically create bonds that have different time series in which they'll be repaid, and then different mechanisms by which you'll allocate losses to those same bonds that are created via the securitization process. But yeah, you have securities buyers, and when you collectively look at what those securities buyers are willing to pay for a package of mortgage loans, it's often well in excess of what the principal balance of the overall pool of the mortgage loans is.
Now, is this what you dreamed of as a kid?
Absolutely.
When you said, I'm going to the University of Texas, I'm going to major in finance, and this is not simple stuff.
Yeah.
This is complicated.
So I would say it was new to me, just understanding really the process by which mortgage rates get set, right? Particularly in the U.S. residential mortgage market. I had no idea. I'm not sure I ever had, a class or anything along those lines at school that walked you through the mechanics of this. Of course, today, given the GFC in 2008 and the subsequent aftermath of just what went on, a lot of which was, part of the process of bundling mortgages was definitely part of that story. You've got a lot of classes, right? You've got a lot of sophisticated, modeling, financial modeling type of classes that get at really the fundamentals of securitization, right? And it's pretty widely not just known, but classes like that are broadly offered now across quite a few universities.
But that world has changed. That was not the case until after.
Yeah, and I think you had to learn it on the job,
right?
Really, at that point in time, I certainly hadn't had any exposure to curriculum work and whatnot. I mean, you would have courses where you would study the University of Texas. You would have courses where you would study a company who themselves were a securitizer, and they used it as a means by which they could attain leverage to generate a levered return on a, package of not just mortgages, but consumer credits, so credit cards, auto receivables, these sorts of things.
And this was discussed in a class.
You saw what they did to get the leverage. It was an option aside from issuing corporate debt or other means of attaining financing, but really getting into the bowels and the nuts and bolts of what it meant to put together a securitization from a legal construct perspective, and then what it meant to structure the cash flows and market those cash flows to different buyers throughout a marketplace. I certainly never had any exposure to that.
Yeah.
So,
yeah. And listen, I think we could spend a ton of time and have an educational class on securitization, on mortgages. And I actually think that people would be very, very interested, because I don't think most people fully understand unless you immerse yourself in that business. Because I think the vocabulary, number one, is challenging, right? You're coming out of school, you don't know what these guys are talking about all the time, right? I mean, it's a little confusing.
that's a great, cocktail party question, to your friends, is to ask, whether they appreciate how mortgage rates are set, right, in this country, or consumer
They have no
credit
idea.
rates, right? And it's this blend of capital markets and asset buyer activity that really sort of churns all day, every day. And the output is effectively a price of money that then, is marketed to the consumer, and it's delivered back into the market, and it's just this perpetual feedback loop. So it's an interesting process once you get to know it. And obviously it's a, growing space. Consumer credits and securitization is by no means novel today, and it's applied across a whole, new set of industries every year, and new ways in which you can, carve up cash flows and distribute to the capital markets. But yeah, my first exposure to it was learning about it through the mortgage lens.
Yeah, it's fascinating.
Right.
All right, so let's jump ahead a little bit. We're in New York. We're at Bear Stearns, analyst. Where do you go from there? What's the progress for Robert Durden? And then did it get stopped or accelerated in 2008, 2009, 2010?
Yeah. So you really just evolve. The way the program was set up there was you just evolve into different aspects of the business, right?
Okay.
There were colleagues of mine that pursued a path in trading, right? So you actually went down, you owned a position. Others who went and focused on just the structural element of the securitizations, right? Like, how you can just further carve up and tranche a cash flow into just, smaller and smaller increments of time and potentially loss, to really hone in on just pockets of demand in the capital markets from bond investors. There were others who pursued more of a legal course, right? So the process of just buying in packages of mortgages. You've sold mortgage loans in your life. There are legal contracts. There's negotiation to really arrive at what is the business deal, and then there's pricing conversations that come about as a result of that legal negotiation. There's the legal element of securitization development, right? So a lot of disclosure related to the prospectuses that are put together and delivered to the bond investors. There's sales, right? There's folks that just purely focus on the coverage of, bond investors, loan originators, and all, really facets of the business to both bring in the raw materials and put the finished product out the door.
Yeah.
Right. So I really worked in a number of other groups, right? The design was really to move you around and, get you exposure to the business across a number of different real, like, bottoms up sort of learning experiences. So I spent time in, the legal construction part of both securitizations as well as whole loan sales. And ultimately, was starting to move towards a part of the business that is, lending to both buyers and originators of mortgage loans, in 2007, 2008, at the time where, obviously
There was a lot of loans happening.
Yeah, there was a lot of loans out there.
happening. Yeah.
GFC started to take hold, a lot of delinquencies and whatnot. So I really took an approach where, from a learning experience perspective, I wanted to keep moving around.
And this
you know,
was all at Bear Stearns?
It was
at
all
the
at Bear
time?
Stearns, right?
Okay.
Yeah, up
All right.
until
Tell us what happened.
Yeah, it was up until 2008, and then I moved over from Bear Stearns over to JP Morgan with a group of colleagues, probably God, 20 to 30 people.
Okay.
Right? Mix of trading, sales, mortgage finance. Collectively, that was really the legal part of it, what you might call more banking today. But we all moved over to JP Morgan at the time in connection with the failure of Bear Stearns, the acquisition of the company by JP Morgan.
Okay.
So, and a lot changed then, for sure. Right?
Did your whole world change? I mean,
Yeah.
did it?
I mean, you really went from the whole business model was disrupted, let alone really the financial system. Everyone, I don't need to play historian here.
No,
but
no. We can get into
remarkable time.
I-
That can be a
actually,
whole separate podcast.
I would love to hear your perspective because I knew nothing about mortgages back then. I literally was just started doing loans in 2008, right?
Right.
And so I would love to talk to you about like someone on the inside knew what was going on. Like, did you see it coming? Was it catch you blindsided, or because we can go that. I mean, we can talk that one for a long time.
Yeah.
But
There's a lot there.
there's a lot there. So, all right. So you're at JP Morgan now. Bear Stearns is gone, and your group's over there. But are people doing loans then?
Yeah, the industry really didn't restart. You had a shift, that 60-40 between, really government-sponsored and non-government business really shifted to 100% government-sponsored. Right?
Right.
I mean, the GSEs themselves were put into receivership. And so even that model was challenged, right? So it speaks to just, what happened to other participants in the marketplace. Obviously several others failed similarly.
Yeah. Oh, yeah.
But you really didn't start any new business for a number of years thereafter, right? What you had at the time was you had a lot of legacy issues, obviously, a lot of impacted borrowers who took on mortgages that, weren't repaid on a timely basis. A lot of foreclosure ensued as a result of lack of payment. And so the knock-on effect was that all of the capital markets participants that were involved obviously had, product that was, very rapidly deteriorating from a quality perspective, and, which they needed to address in one way, shape, or form, right? Many of the holders of those products opted to sell the product. Others opted to restructure for either, credit enhancement purposes, i.e., they could take what they expected to be the losses and at a cost put those out into the capital markets, or restructure those holdings for regulatory purposes. So what you ultimately ended up doing in a seat immediately after the GFC was really sort of pivoting back inward to a lot of the issues at the time. And there was a lot of just restructuring work that had to get done as a result of just the sort of hangover effect of everything that occurred pre-2008.
So, I mean, you guys were all workout specialists at that point, right?
To some extent, yeah.
Just a lot of different
It was a lot of
parts.
that, a lot of different shapes and, forms. We worked with and worked for the FDIC. We worked for the NCUA, which is a credit union regulator who was overseeing a, large set of holdings that numerous credit unions and other insurance companies, no longer saw as money good, right, from a projected loss perspective.
Yep.
And so there's just a lot of reconfiguration of those holdings. A lot of trading activity started to pick up, but not in the loan space. It was all really sort of orchestrated around the legacy bond space. You had dollar prices on bonds that went in some cases from 100 cents on the dollar to 20 cents on the dollar because there was just literally no buyer of them. There was no leverage for them. A whole lot of the markets that supported the price that had come to be the known price just unraveled.
Oy.
And so there was just a lot of,
Chaos?
a lot of chaos and disruption.
Okay.
Yeah. So,
All right,
but it was
so
interesting.
I'm sure
Very
it was-
interesting.
I'm sure you learned a ton, and I'm sure
Yeah.
it was fascinating. All right, but all right, I want to know because you went to Credit Suisse at some point.
Yeah.
When did you go there? And was there anything in between JP Morgan?
No, I was with JP Morgan until 2014.
Okay.
You started to see the makings of, kind of new issuance again, the non-agency market, a handful of participants. Really as early as, I'd say, maybe 2011, 2012, started to think again about securitizing newly originated mortgage loans that sat outside of that government world, right? So the first thing you saw coming about from a product set perspective was what the industry would collectively call a prime jumbo borrower, right? So think a borrower that's borrowing at the time, above the Fannie and Freddie conforming limits. So at the time, it was probably somewhere in the $600,000 range on average across the country, with higher levels in different parts of the country. A 750, 760 credit score, putting anywhere from 25 to 35 points down.
Wow.
Right, so a pretty stable mortgage profile from a credit perspective, all at that time fully documented. You still didn't have the ability to repay rule, hadn't come out yet, post Dodd-Frank, which was finally passed in 2014. So you really saw this, product start to emerge, but it was a very, kind of safe from a credit perspective product that was the first raw material that started to get included again in the securitization world. So worked on, with some of my colleagues to, ultimately launch, and get approvals to securitize again at JP Morgan. And then moved from JP Morgan in late 2014 is when I moved over to Credit Suisse.
Was it just you or did a team again of people go over there?
No,
together?
I moved over there.
Oh, you did?
Just on my own. Yeah.
Okay.
Had some colleagues that I had crossed paths with in the past that were over at Credit Suisse. They were, they were really embracing the sort of new mortgage, the relaunch part of the business. And, you work and do things and work out for long enough, you kind of want to explore new things and grow again and build from a restart perspective. And so that interested me to going over there, and I made the move in late 2014.
All right. So I'm just looking at the clock. So we I know you got a call to be on soon, but I do got to jump a little bit to how did you get into, or what part of your portfolio is the hard money lending space?
Yeah.
I know that's not what we call it, RTL space, right?
Yeah.
Residential
There's
transitional.
a number of names, right?
Yeah,
We've got
yeah.
internal names for it, external, right? Short of it. Well, really at Credit Suisse and really across the industry, what you started to see over time was really a shift away from that principal business, right? Like certainly trading desks at large banks are still involved in the buying and selling of mortgages, but the majority of that activity, when the market really came back from a new origination perspective, started to gravitate towards credit investors, and partly with the passage of Dodd-Frank and some of the regulatory impacts of that legislation on the banks, it just wasn't a business that they could be as nimble in and could be as large in. And so what you saw is a lot of that activity migrated out into really a private investor set, right? Anyone from hedge funds to private equity firms to, mortgage REITs, asset managers, a whole host of folks started being really the credit owners of mortgages again in the country, right? So what that meant from an institution perspective, a bank or a broker dealer, was that meant the business really started to migrate more to a client business first and foremost, where you're lending, right, to those buyers of assets who themselves look for leverage in the interim from a bank, right, or from, those that are willing to make loans in the space, typically banks. And then ultimately they're replacing that bank lending with securitization, right, as a form of long-term financing, right? So Credit Suisse had, really the kind of first mover advantage to move into some of those spaces, really seized on the opportunity to take a whole lot of new entrants into the space from a client perspective, was able to gather the internal approvals to first start lending to a lot of those institutions, and ultimately the securitization business came out of that. So it was really a dual-hatted approach to financing your clients first from an internal perspective to the sort of flavor of the day, if you will, or the preferred choice from a bank loan perspective, and then ultimately taking those same clients back out into those same capital markets to finance themselves on a long-term basis. So that's really where the business of lending and securitizing came about, from my perspective, like my career perspective. And so what we started to see a lot of, really dating back to 2015, 2016, was a lot of the clients who were involved in the non-performing loan business,
Okay.
right? And had the experience of really buying property at the courthouse steps and really being investors in U.S. residential real estate from an early stage post GFC.
So were these the guys that were buying the single-family homes, some of the big boys that got into the Blackstones of the world that got into buying the single-family?
I would say they were buying, but they were buying for the purpose of renting.
Correct.
What we started to come across were more and more people who were buying for the sole purpose of really turning a profit on that house quickly. Not necessarily putting a renter in place.
They wanted to flip it.
Yeah, they wanted to put work into it in a lot of cases. Houses that at that point have been through years of a foreclosure process often had a lot of neglect, had a lot of deferred maintenance, things of that nature that, they would put the capital up, to sort of right size and would then go try to make a profit on that, improvement costs that they put into the property.
Okay.
So we started seeing a lot of clients who were migrating really away from what was even then was a shrinking non-performing loan universe and started moving into, first the principal business of just buying at the courthouse steps, putting money in, and then turning a profit and just rinsing and repeating.
Were you guys financing people buying at the courthouse steps?
We were, yeah. So we started small. We
That's
were doing
a whole
some
other
of that.
I mean, how did you
Exactly,
guys
directly on
get
property.
comfortable with that?
Yeah, there's a lot of there's a lot of client screening that goes on in that process. But there were a handful of folks that really took an approach that was institutional in nature. A whole lot of controls around the effort. They themselves had a lot of capital in it.
Skin in the
So,
game.
yeah,
You guys like skin in the
game's
game.
huge, right?
Yeah,
So it made it an easier business proposition for us to sort of run through our own approval processes internally at that point in time.
Okay.
What we saw come out of that then were a lot of the folks that were accustomed to making a certain return on flipping properties themselves could no longer, right? There's 25 people at the courthouse steps,
Too
each of which
competitive.
have a pretty deep checkbook with plenty of buying power.
Yep.
And they really just started moving away from the principal business. And some of our first clients, were early, probably not early in the grand scheme of
Sure.
hard money lending, but
Big boys early.
from an institutional perspective, some of those folks started to realize early on is, well, maybe I don't want to buy that house and take the principal risk myself, but I'll make someone at that time it was 60 cents on the dollar loan, charge 15%, get a couple of points up front, and guess what? If that business proposition doesn't work out, that person can't make money on that home, and I have to take it back at that basis. That's actually an entry point that I would have bought the house,
I'll be
off the
okay.
courthouse steps to begin with.
Right.
So some of our first clients in the space were really, they grew out of that principal proprietary business themselves and just said, well, if I can't own as much property, the next best thing is lending in the space, right? So we would then extend warehouse lines and, bank folks that, again, had a lot of DNA and a lot of experience and scar tissue from a property buying perspective, dating back years before our involvement.
So I'm amazed now. Now I'm even more I'm fascinated to hear how in the world, other than our broker friend calling me, putting us together, to decide to do with an organization like ours at Longhorn to do a loan. Because
Yeah.
Had you done one with someone like us before? It sounds like mostly you were with institutional players
I'd
before
say
us.
predominantly institutional, but I think, over time, any market and really any business space, if it sticks around long enough, it's going to evolve.
For
right?
sure.
And so what we saw out of that was very different than when we first got in was that, there was really, it was no longer just a cottage industry that was funded in a sort of, not to discredit it, but
No. It's
in
mom
just
and
sort of
pop.
like a small time sort of sense where
sure.
you had to really focus on liquidity and where that next dollar of equity came from. And, not to say that those things aren't relevant, in large scale mortgage companies, but, predominantly you're able to raise capital in a much different way at some of these institutional places than what we had historically seen in this space, right? So that it didn't stunt our interest in the space. I think we've always had, an interest in the space because it does a lot of good from a housing stock perspective. There's a lot of tailwinds behind, a lot of what is done in housing today because there's quite frankly just not enough housing for the amount of buyers that are
And-
looking to purchase in the market.
And that directly relates back to the GFC, right?
That's
I mean,
right.
that
Still
that
a
caused the
carryover
housing
effect.
shortage.
That's
Absolutely.
right. It's that, a lot of, local regulation and whatnot that just makes it difficult to build in certain places, all these sorts of things. It's complicated and it's different everywhere. But from a supply-demand perspective, that gave us a lot of tailwind support to really start to pay attention to this space. And I just think, in a lot of cases, we just had to wade through a lot of the industry and get to know a lot of folks. And a lot of them had great businesses and built great businesses, but just weren't at a place in their development where we could enter yet, right? And so, fast forward to when we met you all, right?
Yeah.
You've obviously got a very long history in the space. You've been doing this well before I ever got involved in it.
Yep.
So, a lot of those factors weigh into it, but also from just a process perspective and a, people perspective, there's a certain way that folks that want to build a business and have longevity run their organization, right? It's prudently managed. Growth is, in a lot of cases constrained, like maybe more so than the opportunity would suggest.
Right.
This is a space that's grown tremendously in size, just in the last couple of years, as a result of a number of different factors. But the way we've always gone about it and what we've put a lot of emphasis on is just underwriting the principles in that business and how they go about playing the long game, right?
Yeah.
And it's a really hard thing to put your finger on in terms of the formula for success that you'll see, and every time you see it, that's the one you want to be involved with. But, through a series of meetings, a lot of diligence, and really just getting to know your counterparty.
I'll stress
right.
a lot of diligence.
That's right.
I'll stress that a lot.
There's just a growth that you see has been, sort of attained from an institutional perspective. And, a lot of times what we see that we like is just top to bottom in an organization. You've got a lot of just connectivity, but a lot of like-mindedness in terms of, ownership, right? And making decisions really for the betterment of the company. Obviously, you run a big customer service business as well, right? But that doesn't mean you can just always do what the customer wants you to do, right? There's always a...
Well, we're not going to say it. Remember, the customer's always right.
Customer's always right, but that doesn't mean you're
Right.
always there to meet him when he's right, right?
can't.
You try to be.
It's hard.
But it's, it's in many ways, it's one of the things we talk about. It's very much a soft underwrite. Obviously, you have to look at the product and you have to understand why the product is the way it is from a, structured perspective, from an offering perspective, and that's, increasingly more and more complicated as you see more folks in the space move into the sort of builder loan space and doing a lot of things along the lines of ground up and trying to, just quite frankly, add more products that can be helpful to that supply-demand imbalance from a housing stock perspective. But there's just a lot of, knowledge that I think people have to have around the products that they're offering that is, quite frankly, what we look for, right? You have to have been there, done that, been involved for a significant amount of time for us to really consider someone from a counterparty perspective.
And maybe, some people, I think one of our benefits, our strengths is that I feel like we've made every mistake, so we've learned a lot over the last, 17 years of doing this.
And we're there with you, right? Over that time frame, we've learned a lot from our mistakes, and
Yeah.
I think that's the important part. You're always looking for someone who's constantly looking for ways to improve the organization, improve the people of the organization, share information, and you know it when you see it, right? And it's a lot about leadership and how that leadership really permeates the different parts of the organization. That's a very important aspect of the underwrite, not just for clients of ours in this sector, but in any sector.
Any business. Robert, I could talk to you for hours. Look, there's a lot of things that I would like to get back and cover with you. I would love to talk about the GFC with you. I'd love to get your opinion, if you're allowed to share it with us, on why it happened, what caused it. But you have a call in 3 minutes that we have to get you off to. But thank you so much for being on. And this is part one. We will do part two then.
Sounds good.
All right. Thanks, buddy.
Thanks, Mike.
Bye.
Call up Longhorn, told them let's make it rain. They said, boy, we got you, gone and do your thing.